So let's go ahead and start off with a quick review. Since some of you, this may be, you know this backwards, but I'll just review some of the Kaya material on managed futures to get us all up onto the same page. So managed futures is a subclass of alternative investment strategies where professional money managers, which are also known as commodity trading advisors, actively take positions primarily in futures markets, forward markets, options, and other liquid derivatives and structured products. Now, given the array of highly liquid contracts that they use, this allows them to have access to risk and exposures in a wide range of asset classes, from fixed income to currencies to equity indices to soft commodities, energies, and metals. So it's a very broad set of drivers for risk and potential exposures. Futures market in particular and other derivatives markets allow for access to something which is called implied leverage. I'll explain this in a little bit more detail, meaning that it's much easier to get leverage in contracts with lower required capital inputs. So this allows managed futures managers the ability to go long and short a large number of asset classes with relative ease, and have access to sort of highly capital efficient leverage. So the challenge with managed futures, and I think some of you, I myself who've written a lot about managed futures, is it's a strategy who's defined by what they trade as opposed to the strategy itself. So when you get into the space of managed futures, you start to realize that there is quite a myriad of different things that one could do. So let me just summarize how to think about these across several key dimensions. So first of all, 4 key dimensions to think about, this comes also from the Kaya level 2 readings, is the data sources that are used, meaning are they using technical and price data versus fundamental inputs? Second is the investment style, systematic or discretionary. The third would be the strategy choices. So it'd be momentum, mean reversion, carry, global macro, relative value. As you can see, almost all typical hedge fund strategies can be applied in the space. And finally, time horizon. So it'd be anywhere from high frequency to long term. Now, one of the key things here in this graph you'll see is that I've highlighted the strategy that's the most common, and that is systematic trend following. And this is the one we'll probably spend the most amount of time discussing. So that would be technical, systematic, momentum trading on the medium to long-term horizon. Okay, so let's just summarize quickly the benefits of managed futures from the Kaya. So this would be diversification, performance, access to multiple markets, transparency, liquidity, no withholding taxes, and low currency risk. So just to quickly finalize with the benefits of managed futures, and this is something which is a little different when you go through literature on hedge funds, is that managed futures as a strategy is better known, and this has been documented by the work of Littner, by Kat in 2002, and by several other academic studies that show that managed futures as a strategy can reduce risk for any portfolio of traditional assets such as stocks and bonds, and it's more effective as a diversifier or risk reducer than hedge funds. So this is something that the institutional landscape has really taken a hold of, and we'll talk about that a little bit more in detail later. So one last thing I wanted to review from the Kaya, but also from how to think about the world for managed futures. And this is something that we as managed futures managers or managed futures specialists sometimes forget, and that's that the way that managed futures portfolios are constructed is a little bit different than the typical portfolio construction process for a traditional investment portfolio. And this creates sometimes issues because it's like 2 different languages in some sense, that most traditional investments focus on notional allocation of dollars or yen or pesos, etc. But in a managed futures portfolio, portfolio construction is about risk allocation as opposed to notional capital allocation. So we can think about a managed futures portfolio being similar to a barbell portfolio, in that if you think about, I'll show the pen here. Here on the left here, you see that most of your cash is allocated into a funding cash account in T-bills and cash, which is very low risk, whereas the rest of your portfolio is in a futures account, which are collateralizing futures contracts. These are extremely high risk. So you have this barbell portfolio in cash terms that much of your risk is associated to a very small portion of the portfolio, whereas the rest of your portfolio is very low risk. As a result, in managed futures, the way we tend to think about building our system is about thinking about allocating risk. So from a risk perspective, we often barely even talk about the T-bill portion, or the 80% of our capital that is allocated in cash accounts, whereas we have about 20% that's allocated to collateralize these futures contracts. That is how we think about portfolio construction. So we think about how do we allocate the risk in that red bucket here when we build our portfolios. So our way of thinking about building portfolios is really about allocating risk, not dollars, to individual futures contracts. So now let's turn to the role in an institutional portfolio that managed futures plays. So I'm going to talk first about more generally the role of managed futures strategies, and take a slight diversion and talk about one of my favorite topics, which is something called Convergent Divergent, and review some of the philosophical reasons why managed futures tends to be a very complementary portfolio and why it is risk reducing. Then I want to make a couple of comments about the current market environment, and finally discuss how that relates to the way that pension funds and institutions are starting to think about incorporating managed futures into their portfolios. So the first part of this presentation, I want to go back to a talk that I gave in 2013, a TEDx talk I gave in 2013, and some of my work in the book with Alex about Convergent Divergent. And I think this is a nice framework to try and think about why a strategy like trend following, in particular the most popular strategy in managed futures, may make sense as part of a balanced portfolio. So let's step back for a second, and we start to think about, and I'm going to step back all the way and sort of ask everyone to kind of think about risk instead of thinking about managed futures for a second. So when you think about risk, and this is something that is very personal for all of us, and depending on the type of risk that we're faced with, we can see risk in different ways. So let's assume that there's two different types of people. So one type of person that sees risk as very calculatable, very structured, very understandable. So if you could give them all the possible outcomes, they understand that things happen within some distribution, and it's sort of within that range of distribution over time, so that risk occurs. On the other hand of the spectrum, you could also believe philosophically that the world is somewhat uncertain, unknown, and even if you characterize risk, you can never really know if you characterize it correctly. In fact, that things could be very, very difficult to understand in terms of risk. So if we take the strategy C, the convergent view of the world, where things are measurable and understandable, although random, or stochastic process, if you were believing this, if you were to take a simple sequence of bets, let's say that you did a simple did a simple strategy here. If you're correct after one round. You could think about this as a round of a trading day. When you're correct, that confirms your opinion and you're going to tend to take profit. But when you're incorrect, that goes against your beliefs and you're going to tend to either pretend it didn't happen or double up on your position. So a convergent strategy is going to tend to take profit and tend to double up when it doesn't work. A divergent strategy, on the other hand, is going to do the opposite of this. So a strategy that's divergent, when you're wrong, you don't really know why you're wrong because you're not sure what types of risks you're actually taking. But when you're correct, you think, maybe I might have actually found something, so maybe I should keep trying this. So in some sense, a divergent strategy is going to tend to be more likely to cut your losses and likely to follow things that work. Whereas a convergent strategy is going to tend to confirm and take profit and double up when things don't seem to have worked out as they expected. So if we look at these two different strategies, they have very different payout profiles. The convergent strategy has many small wins, which is pretty satisfying, but from time to time, because it's so determined that there is some particular structure to the risk that's taking, it can have very, very large losses. On the other hand, the divergent strategy tends to take a lot of small losses and on occasion make extreme, sort of really large gains. So you can see that these are very different distributions. Over time, the convergent strategy is going to be very satisfying and occasionally very painful, whereas the divergent strategy is going to be frustrating but occasionally exuberant. So let's think about a couple of examples before we turn back to trend and we turn back to the case of trend following. So let's take, for example, one of my favorite examples is social networking. A person who's very convergent in their strategy of social networking is going to have a few very close guarded contacts. A divergent strategy in that space is going to be having many different contacts and getting as many people in your profile as possible. For career choice, a job is going to be very convergent because it's satisfying until you lose it. And an entrepreneur, on the other hand, is going to be frustrating, but occasionally extremely exciting. For projects, task-oriented projects are very convergent. Research, on the other hand, for those of us who know research, can be very, very divergent. You may never know when you're going to get your next breakthrough. So let's turn to two finance examples that I think show this even better. So if you think about the world of private equity, the most common strategy for leveraged buyouts, those are sort of concentrated positions in some high conviction firms. So that's a very convergent strategy. Whereas venture capital follows a very divergent strategy in that they allocate a small amount of equity to a large basket of potential entrepreneurs, and then they follow on with those that work out. So that's a very divergent strategy. When we turn to the space of trading strategies and investment strategies, a long equity strategy is very convergent because it works very well until it doesn't. And in certain environments, when risk is working as we would expect, it seems to work very well. Convergent trades and short volatility are also very convergent strategies. On the other side, long volatility and trend following are two of the only simple examples of divergent strategies. So why, again, just to summarize, is a trend following strategy divergent?